this week's market update, shares continue to rise on stimulus and lockdown exit hopes. A flood of corporate announcements shines a light on the earnings outlook. A number of key central banks hold rate-setting meetings, and other news creeps back onto the agenda. The market rally that's been underway for the past month is continuing this week. Investors responded positively to further easing from the Bank of Japan on Monday and are looking forward to additional measures from the Federal Reserve and European Central Bank at their meetings later this week. Optimism is also rising that some states in the US are preparing for a return to work over the summer. Texas, the second largest economy after California, will not renew its stay-at-home order on Thursday. US Treasury Secretary Steven Mnuchin said yesterday that he expected the economy to really bounce back in summer as parts of the country reopen and thanks to unprecedented fiscal stimulus. Elsewhere, there are signs of a tentative return to normality. New Zealand said that it had overcome community transmission of the coronavirus. Australia reopened its iconic Bondi Beach after a month-long closure. In Hong Kong, civil servants are preparing to return to work next week. The Bank of Japan, which has already set interest rates in negative territory this week, promised to buy government bonds in unlimited quantities and increased fourfold the amount of corporate bonds it can purchase. That follows the decision by the Federal Reserve to extend its bond purchases to include high-yield or so-called junk bonds. Providing a backstop for bonds in this way feeds through into effective support for shares, which stand further down the pecking order if a company finds itself in trouble. The rally in shares, which on the accepted definition up 20% constitutes a bull market since the low point reached in March, is now looking even more at odds with the increasingly downbeat messages from the broader economy and company results in particular. This week promises to shine a spotlight on corporate earnings as a steady stream of bellwether companies on both sides of the Atlantic are scheduled to comment on recent trading. There's a particular focus on technology stocks, which have been one of the few beneficiaries of the ongoing lockdowns. Results are penciled in for Microsoft, Facebook, Spotify, Amazon, Apple, Alphabet and Twitter. Less impressive will be numbers from the oil majors, including Shell, BP, Exxon and Chevron, which are coping with a catastrophic fall in the price of oil from a high earlier in the year of more than $70 a barrel to around $20 currently. Last week, the price of a barrel of oil actually fell into negative territory for the first time, thanks to a shortage of storage capacity. With nowhere to temporarily hold excess supplies, falling demand thanks to industrial shutdowns and grounded aircraft is triggering an unprecedented game of pass the parcel, as no one wants to take delivery of oil that they cannot store. Other companies in focus this week include big pharmaceuticals companies Glaxo and AstraZeneca, banks such as Lloyds and Standard Chartered, and retailers including Next and Sainsbury's. This morning, HSBC unveiled a 48% reduction in first quarter profits as the bank hiked bad loan provisions from under $600 million to $3 billion. BP announced a sharp fall in profits but paid its dividend, a relief to income investors in the UK. Earnings in the first quarter will only, of course, partially reflect the impact of the coronavirus outbreak, because outside Asia, the most damaging lockdowns only took place in March. More interesting for investors will be any guidance they can glean from managements about the outlook for the second quarter, which everyone hopes will be the low point of activity. The extent of the recovery from the expected dive in profits in the April to June period will depend on the effectiveness of the tentative returns to normality that some, but not all, countries in Europe and some states in the US are starting to communicate. A notable exception to the easing strategy is the UK, where Prime Minister Boris Johnson, back from his own COVID-19 nightmare, warned that a premature return to normality would be a costly mistake. Working out how and when to restart shuttered economies is the biggest question many politicians will ever face. Leave it too late and economies will grind to a halt. Go too early and a second wave of infections and a repeat lockdown will be equally disastrous, both from a public health and an economic standpoint. The stakes could hardly be higher. Morgan Stanley this week forecast that the Eurozone economy could contract by 11% in 2020, more than twice its previous 5% prediction. The bank said that recovery would be slower than expected as countries lifted restrictions only gradually and large-scale events remained off the cards for the foreseeable future. The initial drop in activity would also be deeper than it had previously forecast. This week, we'll get updates on both US and Eurozone GDP for the first quarter. In both cases, as with corporate earnings, these will tell only half the story. The second quarter is expected to be when the greatest damage is felt. The stock market's ability to see through the gloomy news is starting to look impressive compared with historical comparisons. During previous bear market rallies, a recovery of 50% of the initial fall has tended to indicate the bottom has already been reached and the next upward market phase has begun. However, there's one glaring exception to this rule. In 1929, the stock market retraced half of its losses by the spring of 1930, only to then fall much lower over the following 2 years. Between 1929 and 1932, the Dow Jones Industrials Index lost 89% of its value. The late 1929 rally was one of the stock market's biggest ever suckers rallies and a chance to move to safety that many investors came to deeply regret passing up. What happens next in 2020 is impossible to predict. It's true that central bank and government stimulus has never before been seen at today's level, but it's also true that pretty much every bear market provides investors with a false feeling of security at some point. One market which has shown that assets can fall a great deal lower than anyone predicted when supply and demand are misaligned is oil. After last week's technical dislocations, which saw the WTI contract briefly trading deep into negative territory, things have settled down a bit. But WTI is still priced barely above $10 a barrel, while the Brent contract is now under 20. Stung by last month's volatility, no one wants to be on the hook for accepting delivery when the June contract expires later in May. United States Oil Fund, the largest oil ETF, has sold all of its June contracts, 20% of its $3.6 billion portfolio. Heading the other way is gold, which last week hit a recent high of $1,775 an ounce, as investors sought out safe havens during the turmoil in the oil market. Gold has come back a bit since then, but still trades at over $1,700, up from under $1,200 18 months ago. Meanwhile, other news is starting to return to investors' radars, albeit still playing second fiddle to coronavirus fears. Last year's big story here in the UK, Brexit, has largely disappeared from view in recent weeks, but despite the lockdown, remote negotiations have restarted on the terms of Britain's departure from the EU. The transition period after January's official exit is due to end at the end of 2020, unless the government requests a 2-year extension before the end of June. Downing Street has been resolute in denying that it will do so, but there's almost no one left who believes that a deal can be struck and approved in the next 8 months. The other story that was supposed to dominate 2020 has also fallen out of the headlines. But short of something really unexpected, the US presidential election will take place in November and will be contested by Donald Trump for the Republicans and Joe Biden for the Democrats. The coronavirus crisis has been a disaster for the Democrats, removing their ability to get their man in front of the cameras and handing all the publicity, good and bad of course, to the incumbent. As in other countries around the world, an existential crisis such as corona has tended to create a rally round the flag mentality, which favours those already in power rather than those trying to unseat them.